G'day guys, welcome back. Tankers to episode 55, Money in the Tank. As you'll see on the screen today, we've got myself, Joel Seach, Principal Advisor, Harpel FG.
Brad Tabone, Startup and Generalist, and Ben Leach.
Hi.
Welcome, CEO of Hammertech. Welcome to the pod.
Welcome to the pod, Ben. So
Thank you very
we've got a different Arnie today. Not Arnie today. Arnie's again out of action. Arnie's house has just been sick all year, so Arnie's out again today.
I feel sorry for Arnie. He's had it tough this year with his kids.
Yeah, been a rough year. It's good to have Ben here with us because we did have planned to have Ben anyway as a Q&A, so it's great. We've got the third spot filled, and we've got a episode jam-packed for listeners out there today with all things startup and what Ben does in a CEO role and how that sort of transpired for him over the years from a Hammertech startup with yourself and Brad. Well, some good Q&A stuff, so keep an eye out for that today. And also a little bit of a quick market update, some Renee Rivkinisms with your favourite quote of the day. And a good 50-50 at the end of the episode. So we're looking forward to it. And because we don't have Arnie here today, Brad, would you be able to tell the listeners where they can get us at?
Get us a Money in the Tank on YouTube. If you're listening there's still about 40% of people that are listening that aren't subscribed. So as Joel said, no free listens. Hit the subscribe and notification button. Should be illegal. Get us on Spotify, Instagram, and Twitter. Money in the Tank.
Absolutely. So digging into the episode today, Renee Rivkinisms. So I forgot the Bible today, as I do sometimes when I go into the office, but I've got a really good list of quotes here in front of me. So I'm actually cherry picking one today, which I thoroughly enjoyed before. He was talking about expert forecasters. So his favorite forecasters are those who are always wrong. At least they are consistent and therefore useful. So that was a
Jim Cramer would be Jim Cramer would be my favorite. Being the guy over in the US that he's an ETF fund that basically whatever Jim Cramer says on TV, they invest in the opposite.
Yeah.
So
the value of expert forecasters is to let us know what will not happen rather than what will. So that to me, it resonates with me because I love talking about investing, but property as well. And my pet peeve is bank economists that have, I guess, their fingers in all different pots of economic forecasts, and they try to play subject matter expert on property, residential property in Australia, and they have no idea. So to listen to them, at least you'll know that they'll be inconsistently on the wrong end of their predictions, which is great. So
correct. We hate them, Benny. By the way, we hate the media here because of how much they sensationalize everything, and they're always late to the party, and they're always wrong. So, that's that's consistent with our ethos. So, guess we'll, Joel, do you want to quickly touch on the RBA?
Yeah, so as the theme is of late, the RBA interest rate hikes. So coming into the first Tuesday of every month, the RBA will meet the Reserve Bank of Australia, and they set the monetary policy. So we were expecting that this month, even though they had some softening inflation data come out, the odds are still a 25 basis point hike for the RBA in Australia, and then they break for January, and they first meet back in February. So it was probably more than a coin flip. It was more a 60% that they're going to go 25, but there was also a chance they might go 0.1 or 0, although they were a lighter estimate. So they ended up going 25 basis points, which brings the official RBA cash rate to 3.1%, I believe. And you'll start to see those come through, home loans and lending over the coming month. The banks and the instos are pretty quick to pass on rate hikes, not as quick to pull them off in terms of reduce. But when the RBA hikes, the banks will usually quite quickly come out and add those 25 basis points onto your variable loans. So I guess a bit of Christmas cheer from the RBA just to try to dent a bit of the consumer confidence leading into the Christmas period and try to hopefully give one last softening of the economy leading into their break, because they won't have much control over December and January until they meet back in February to see. And by that time, they'll have the next month of 3-monthly inflation data in full come out and employment figures, and they'll be able to see where the economy's at and how things are tracking from that regard. And also we'll be starting to dig into 23, which will start to see those fixed rate variable holders, which I've referred to before on the podcast, they'll start to come off and flick over to variables. So that's what they want to see as well, as to how that then also impacts the economy. The Reserve Governor, Philip Lowe, didn't give much away, but just that they've got the ability to tighten when they need to, and they'll keep looking at the data and keep on adjusting as they see fit. Some of the economists that, again, we've spoken about economists taking with a grain of salt, but there's some different economists that have sort of spoken about what they feel will occur with rates, and maybe peaking in next year, and then looking at towards the later end of next year is potentially softening. So we'll see how that all unfolds, but it's going to be so many moving pieces to it, and the world then interjects in terms of coming into the Australian economy. Again, we are well positioned as an economy. We're quite diversified in terms of all the different resources we have, and our exports, even on a market update I was listening to this morning, exports in energy and agriculture are still really strong for Australia. So we're in a good position in that regard. But yeah, so it was an interesting update in terms of the RBA and interest rates as well, which I guess most people were expecting, but we didn't get the 50 basis points that maybe everyone was thinking we might get even a month or two ago. So yeah, quite strange. Ben or Brad, anything on that?
Yeah, I just think that it was a risk. Like, it was just one of those risk plays, which is you may as well err on the side of caution. Another 25 points. They're not going to be able to, as you said, not going to be able to do much in January. They're going to get the new data. And so it's more like, if inflation is a coin flip of continuing, or if they've got under control, they may as well just, 25 basis points isn't going to break things, but it is going to put at least more downward pressure on inflation, and then they can wait and see and make a decision in February. So I think it was just a risk-weighted decision versus not doing anything and possibly, not slowing down things if they're going to have to raise again next year. So it's just that consistency play. And the interesting thing I thought was actuaries over at ING. I don't know if, Joel, you saw it yesterday.
No.
So ING have actually cut fixed rate loans for 2 or 3 years. So I guess they're predicting and 4 or 5. So 20 basis points on 2 and 3 years, and 30 basis points on 4 to 5 years. So
that's interesting, yeah. Because
well, it's interesting to see what those actuaries are doing from a competitive advantage and their modelling over where they're thinking actual things. I believe actuaries more than I believe economists.
Yeah. You're right. Actuaries, that's all they do, and fixed rates actually come off a different money market to variable rates, which is interesting as well. So they come off a bond market, I believe.
Correct.
So
that's where they're predicting economies and bonds and currencies and all sorts of stuff going. So,
and what's your thoughts on that, Ben? Any thoughts on interest rates? How are you feeling at the the consumer level in terms of the variable rates, or feeling anything from a company level in terms of debt?
Well, I was going to say I'd love to contribute, but I'm not really an expert in this sphere. But that said, you do feel it, right? Sort of month on month. When you take out sort of a loan when things looking pretty good. No, not fixed. It was I remember the banks were saying, hey, just lock it down at sort of 2%, and you're like, oh yeah, look, I'm hearing that for the next 5 years it's going to stay pretty stagnant, so let's just keep it on the old variable.
You ignored T-Bone's advice, mate.
Yeah, well, I did. I went with what you call the economist that you were speaking about earlier. So yeah, now we're sort of blessed with copying the 0.25 and the 5 and the 3.5 or whatever they keep on sort of upping. So hopefully at some point it comes out from a consumer point of view, but from the macro side of things, don't really have that much further to contribute, boys.
But Joel, no, you are right, Joel, though. Hammertech debt facility, and it's variable, and based in North America, which is where rates are higher. And so, does it overall, I think, impact, is it a thing that you're worried about, Ben? The higher interest rates, not that much, but it's when cash gets, towards the back end of the year, and you start burning down cash and the rest of it. An extra 300-400 basis points on a debt facility adds up.
And I know a lot of mortgage holders in the US tends to be more of a fixed environment over there.
Yes.
Business lending facilities tending to be more variable than fixed. Yeah, is it?
More variable. Yeah. So your kind of PE firms and your family offices and kind of your credit providers that offer debt facilities to businesses, they generally, because they're lending to startups and higher risk kind of environments, they will kind of want to protect themselves. And their money coming in are highly correlated to the capital markets, more so than, say, a bank, because they don't have depositors and etc. So their cost of capital is higher. And so whilst domestic homes are fixed over there, your kind of places that will offer debt facilities for startups, definitely variable. Which carries on, I guess, the topic of startups to today. And again, welcome, Ben.
Thank you very much. Thank you.
Ben and I, everybody, have worked together for the last
8 years.
8 years. I kind of ran away.
Sorry to hear that, Ben.
Yes, thank you. I appreciate that ahead of time.
I'm docking you for $2 for that one, Joel, for interrupting. So Ben, we have an interrupt rule since I used to interrupt a lot, and me and Arnie, and so it's $2 every interruption. So I'll peg Joel for that one.
That was worth it.
It was worth it, and that's the other thing. We generally just interrupt happily and pay the $2. Makes it more worthwhile. Make it sting a little bit more. And so Ben and I worked together for 8 years. Pretty closely, I would say, kind of growing out Hammertech. And I thought I've stepped away from day-to-day operations, really coming on, what?
18 months.
18 months? Yeah, wow. Ben's obviously still over there with Harry and a couple others of the co-founders. And I thought it'd be get someone else on, because I haven't spoken too much about Hammertech. I just say it every now and again. But I say I'm the startup guy at the start of every episode, and we hardly ever talk about startups. And I say that people always generally ask about how do you get into Hammertech and how do you do this, and I didn't really want to kind of do an episode me. And so I thought we'd bring Ben on the pod, get a totally different perspective.
Just in case the listeners didn't hear at the start, Ben's the Chief Executive Officer of Hammertech, and obviously started up at the sort of the initial stage of the Hammertech for a number of years now, and I just heard over there, based in the US still.
Ben's based in Melbourne.
Based in Melbourne, sorry.
I was the bit of slab of meat, me and Andy over in America. Ben played that one well. So Ben, I guess I was going to throw over to you. Bit about yourself, current role, what you did before Hammertech, and I think tell listeners kind of what got you into thinking about getting into the world of startups.
Yeah, thanks very much for the intro. Those who know me are probably sick of hearing the story, but sort of educated in construction and engineering. That's my background. Worked in construction firms and project management consultancy for 15 years. Sort of long hours, long days, but that's no different to what we experience these days either, right? But I think it was the big catalyst behind it was just solving problems that you have to deal with every day. And so the concept of it came in sort of 2005, 2006, and working in safety management, very heavily administrative, lots of leverage files, keeping all of the documents in order. And there just had to be a better way. And so it was trying to unlock that, but didn't have the wherewithal or the expertise to be able to execute on that. So it was just by luck that, through my career, I worked with a guy called Lucas McDonald, and he lived with a guy called Brad, who's on his podcast at the moment. And he had a side business with another guy called James. And I guess that's how startups can sometimes start. I just think we were hugely fortunate to have had that group that we did. And then early within that first 6 months of when we sort of kicked it off, we were lucky to come across another guy who's well known to Harry and Brad called Andy, and he became our honorary fifth founder. And that's been our group from day one, and it's still our group today. And so in terms of what got me into it, I think just pursuing a passion. I think after 15 years, just sort of pounding the pavement and being beholden to somebody, we had the ability to go out and do something that we thought was going to be really meaningful and really start our mission of trying to help make sites safer across the globe.
And in terms of, obviously, working in the industry for 15 years, you're in a pretty comfortable position, and there's a lot of people out there. I mean, I've got a ton of friends that recently are thinking about, like, do I do a startup, or they've recently got into a startup, or they're trying to do a side one. What advice do you have with hindsight? So what did you think you needed to do from a planning perspective? Now, did you do any financial planning? How did you kind of, what was your family situation in that perspective? So what did you take into account that? And then with hindsight, what would you kind of recommend to the pod listeners if they're, thinking about, they've got an idea and they see, a process or something, an idea that you saw, what would be the kind of, recommendations that you did, what worked, what didn't? And then with hindsight, what would you kind of...
It's such a great question and such a hard one to answer. I think that anyone who wants to go and do something, you'd be fully encouraging of it, because I think the biggest learning has been once you follow your passion, the monetary thing sort of comes to the side. But that said, when we both had sort of 2 full-time jobs, and we decided, Brad, I remember when I told you, hey, I've quit my job, I'm going to go full-time. And when you talk about the financial planning side of things, will we sophisticated? Short answer is no. We just went, okay, well, we can handle that. My wife was still working and we still had an income coming in. And without going into too much detail, we were trying to have children for a long time, and we thought that may or may not happen. And so we just kept on keeping on with investing and doing whatever we felt like doing. And then all of a sudden we were fortunate to sort of fall pregnant, and then we had no incomes coming in at all. And we had all of this investment, and we had a sort of pending baby, and we had a startup, and the startup was earning $0. So couple the passion and the enthusiasm, but that also adds a huge amount of stress, because startups, especially in the tech space, they're not automatically profit generating, right? And so to get to that point where you can actually pay yourself, I mean, it was a long road for us. And so in hindsight, in hindsight, we didn't really plan for it. We just sort of lucked our way through it. So
you say that's because you're sorry to interrupt, but you say that's because the financial position you're in is double income, no kids, mid-30s, kind of owned a couple of investment properties or whatever it is, not divulging, but is it due to that kind of, you're just thinking, no, I can take a punt for a year or two?
I think so. I think exactly that. And I thought we sort of thought, well, we'll at least have one coming in. And so, we'll experience some burn. And at some point you'd expect, we were hoping, I guess, a hockey stick, but it wasn't really a hockey stick. It was more just like an incremental opportunity when
not like TV.
Yeah, well, exactly right. It wasn't like that. So to answer your question, I think absolutely follow your passion and be able to do it. But I think there's just a reality check. Brad, we know more than any that you're not guaranteed for success in this space. So
what are the numbers, Ben? What's the numbers of a successful business getting from a startup between $0 to $10 million in revenue, which is not even success?
I think it was under 1%, isn't it? And so, and in terms of what you deem as success, you're just sort of cruising along and being happy doing that, or are you trying to create, a high growth business? I mean, at the time, we just started something, right? Because I think we wanted a change in our life. I guess the business side of things has sort of grown over time. But it's been a real journey. And I think that again, to sort of circle back on that initial question, follow your dreams, but just keep your eyes open. It's not as straightforward as everyone thinks.
Just a quick one there. I've written a couple of words down there that were interesting that come from, I guess, in a planning background. We talk to clients around behavioral stuff and subconscious stuff. And, to me, Ben, you don't come across as a big risk taker, but probably what you did is a risky play, but it also gets driven from passion and want to make change in your life to something you haven't done before. And sometimes I feel that when you're young and you're in your 30s, almost blissful ignorance is a good thing, because if we knew what we were stepping into running a business or going out into a startup, no one would ever do anything, because it's just like when you're in there, it's like, geez, you just got to make it work. You're in there and you've cut your ties with your job and you've gone to one income, and it's just interesting, some of those words there in terms of fearlessness and passion and getting into something that you want to drive and you want to make it work, and not a huge risk taker, but you hear that sort of stuff all the time, and I think it's brilliant.
I think it's a great point. Joel, I think my wife was saying to me from day one, I've still got the photo, walking out the door without the suit and tie and just with my bag and my polo shirt on, just thinking that this thing's going to be fantastic. And she said, you're the happiest I've ever seen you in like our 20 years of being together, right? But then the financial planning side comes in sort of 8 months down the track to say, geez, I love that you're enjoying this. But at some point, like there is the reality of life, and we need to be able to sort of generate some income. Otherwise, the dream comes to an end, right? So I think that's what's coupled. It's coupled with the planning side of things, which could have probably, I mean, maybe you're right. We talked about when we started Hammertech, if we'd done a real competitor analysis, you'd be like, oh, this competitor, too hard, let's not do it. So I think that ignorance, is sometimes a blessing as well.
Yep. I think we have a saying, which is, are we glad we did it? Yes. But will we do it again?
Maybe
no. And I think that's kind of, but I think, that's my take out. And I guess wanted to get your perspective, Ben, which is, I think definitely follow your passion, but maybe do a little bit of financial planning, because people, I think, and try and do it as a side if possible,
I was going to say, a
aside,
lot of people do that, and they sort of carry on with
right?
a gig on the side to kind of keep some stability of income. And
Yeah,
Ben obviously had a bit of a safety net financially, but also had your wife there was working, so that's great. And you've only got, essentially it's general in nature, as we always say here, in educational purposes only, but your life's too short to not follow your passion. If you're following your passion, you'll never work a day in your life, and you'll always love and enjoy what you do. And you've only got one crack at it. And if you never took this journey, then you look back in your 60s and you might say, okay, well, great, I've got some net wealth and I've worked really hard, but I've never really loved or enjoyed necessarily what I've done. And now you've taken a different road, and the road's full with a lot of bumps and dips and troughs and ups and downs and fights and long nights and whatnot, but you're doing it from an underlying point of view of passion, which I think, is great.
goes a long way. And I think, like you said, Joel, I think there was always the, I guess, the premise that, especially if you're in your 30s, I think, and you've spent at least 5 years within an industry where you've built, a career that you can return to. I think that also de-risks things where you can say, look, I'm going to give this a punt. I've got enough money to last me 2 years. And look, if it doesn't work out, bummer, real bummer, because a lot of them don't. And we all took that. I mean, we got together at the end of the first year when our revenue numbers were roughly about $4,000 annually. And we're all sitting there, and Ben was like, I need to earn about 10. And I was like, yeah, but where are we going to get that from? It was like, we got a long road, right? And it was like, we're going to have to take a different approach. Okay, so over the next 6 months, we hit this number, we'll keep going. If we don't hit this number, we'll pull up. And I say that to people all the time. We're within, and we only hit that number that we wanted, like, on the way, like, March. And so we're only about 2-3 months away from something that, like, today is obviously international and going very, very well. We're in 3 months, and I think you've got to have at least those milestone gates in there, but you've got to, as you said, Joel, chase your passion. So, Ben, question for the listeners. What is the CEO role kind of, you took over the CEO role in 2019. What would you say is like, what is a day in the life of a CEO? Like, what have you been up to the past month, just to give kind of listeners an idea around what a startup CEO does and gets involved in, and just a bit of an insight.
Yeah, I think it's a good question from what does that actually mean? Because I think, Brad, we've always spoken about, if you call me a CEO, I'd be like, well, you're not really a CEO's, backside, because you're just a guy who's been one of a founding group that started a business. And so, when the role sort of came upon, it was like, okay, you're really doing a gap analysis of your skill set, right? And going, okay, well, what am I good at and what am I not so good at? And so,
remember that coffee shop discussion?
Yep. And I enrolled myself in the Australian Institute of Company Directors course, which has probably been game changing for me, from a governance and leadership role. And that's not leadership from like a cultural perspective. It's more from, do you have the acumen? I didn't know how, and I do now, for everybody, but I didn't know how to read a profit and loss statement. I didn't know like what to look at on a balance sheet. Like I didn't really understand the technical sides of that, legal frameworks and social responsibility, ESG being sort of primary sort of topic at the moment. And so, getting exposure to those things that you haven't actually done before, I think has been really paramount and important for that. In terms of what does that sort of mean for me today, our business has gone from, again, getting back to, the 5 founders to sort of 80 plus people next year. We're going to be north of 100. And so, putting the foundations in place that people work in an environment that, psychologically safe, that's enjoyable work, that they're empowered. So much of what I feel that I do is that, the short answer is you don't feel like you do a lot. Because you've come from being a doer, and sitting on the computer banging things out, and you spend a lot of time now thinking and running and thinking, and it all comes back to how are you actually putting these things in place, and how are you empowering your leaders, and putting a framework in place that the business can operate. And true believer, and when you get those things right, the business starts to have good results.
And just in terms of touching on that, Ben, it's a great summary and rundown of being hands-on in your own life and feeling like you're not as hands-on, but you're sort of covering probably a lot of other areas. I'm not sure of the makeup of the board of Hammertech, but essentially you've got the CEO role. There's also a COO role that is in companies at times, may not be with Hammertech, and a CFO. You mentioned before profit and loss and balance sheets and whatnot. So probably, you know, the role of a CFO is more entrenched in that. But you, as a CEO, you want to understand and have an overview of everything. So that was one area, I guess, it'd be interesting to hear what you guys have set up there. And that director's course is super interesting. I've actually looked into that myself, so I might pick your brain on that off the pod. And a really cool thing that you spoke about with culture and making sure that the staff, and as it grows, you're progressing the right culture and the vision. I think I heard Simon Sinek maybe mention once, is instead of a CEO, it's a CVO, as Chief Visionary Officer, in terms of seeing where the company's going. I thought that was a really cool acronym.
And just to like said, sorry, just to add on to Joel's, Ben, I think what will be also good is you can talk about kind of where the culture was in 2019 and kind of what you did to kind of, you know, to address that. So I think, you know, when we're talking about culture, I think it's important to kind of, you know, if there's people out there that are working in a business, whether it's startup or not, you know, what are some of the options out there? And I think, you know, it was funny, I was only having a conversation 2 days ago about when I was back in Singapore, sorry, 3 days ago, about structures. And so there's someone like in a traditional business going, so who's your COO? And it would be good to like kind of just talk about kind of, you know, I guess a different makeup that we've got being a startup for people out there to understand, you know, how things are done a little bit differently.
Yeah, sure. I think people talk about, you know, people, processes and tools. And I think that's at times a little bit prescriptive. And so talking about culture, which we could call that fourth facet. And I think that that's been sort of game changing, as you mentioned, Brad. You know, we brought an external facilitator in, you know, Paul Roos, who coaches Sydney Swans. He was founder in that business and brought very much the sporting culture of feedback. And so in a game of football or whatever game you're playing,
and more important to that, Benny, turned the Melbourne Demons franchise around. I'm a Demon supporter, and without Roosie, we'd probably still be in the doldrums. So Roosie actually turned out.
I'm actually quite disappointed in Roosie because I'm a Bulldog supporter. So we had a flag in waiting there, and yeah, they had the belief, which they wouldn't have had maybe 10 years ago, to be able to get the job done, and they got the job done. But we won't sort of spend too much time on that. But he was a huge catalyst behind that. I mean, Melbourne were fledgling for 50 years, right? And so you're bringing in a culture of feedback and trust, and all these things that, you know, we have this concept of you act your way in and you act your way out. And if you believe in the values and behaviors, which we've never shied away from. So we didn't do a 1-day course, we didn't do a 2-day course. We're still on an engagement with PBD 3 years on, and we do regular team tune-ups. We create an environment, which is not always perfect, but that's why we have it in place, so that we're always sort of looking to do that. And so that's been, you know, through our experience, and we've been part of a 30 by 30 cohort in Melbourne, which is a Launchpad program to sort of bring 30 startups from Melbourne through to a unicorn status by the year 2030, and the number of
unicorn status, for those listeners, is a company with a valuation of $1 billion.
$1 billion. So
and I think your Hammertech's one of the first 7.
Yep. Well, the first 9, yeah. So we're one of the first cohort, and companies that are within that cohort, they sort of almost look to us to go, well, like how have you been able to do that? Because, you know, we all think that it's just now almost just the way that the business operates, and they're now going down that path and saying, hey, can we speak to those people, because we need to work through this. And so much so, as a believer in it, that my wife's now joined the business, having seen what we've done to jump into it, having come from a background in Deloitte and media, going, wow, like to be a part of something where we're actually changing culture and changing people's lives, right? It literally is. You can see that it's really game changing. And so that's been huge for us. With regards to the maturity of the business, we brought a CFO in 2020, and that's been also hugely important for us, because whilst you might have some financial acumen, you know, and understanding, you know, tax structures, and Brad would have to have dealt with it in the US. With every state's got different sort of requirements, and understanding how you're actually structuring a SaaS business for growth, and just also getting comfort that you have a good understanding as to where the business is at and where it's going, and being able to give sort of tangible numbers in terms of you know, where we're at, to give us comfort as to, you know, that we're going to be all right, has been hugely important. And I think that's probably something that you underestimate also. When you're a startup, you can sort of hack it together, and, you know, Brad was doing a bit, I was doing a bit, Lucas was doing a bit. We were coming together to try and make it happen, and Brad has had the most experience in that space. But then, like, none of us are sort of chartered accountants, right? And so to then have that experience of different tax structures in different countries, and just how you actually set this stuff up, huge.
And then from, I guess, a structure,
peace of mind financially from a company perspective to know that you're on the right track with it. And it's funny, you link that back to personal financial when you talk about financial planning to start something up. You're getting to a stage now where it's like, okay, well, we've started up, we're working well. How can we make sure we've got peace of mind that financially things are on track and bring in that CFO rather than trying to piece it all together yourselves?
Yeah, I mean, like as you try and scale, scaling is like a very hard thing. And what scaling means, for people in startup world is as you grow, you start off as 5 founders, which is more than usual. And we were told that was a stupid number and it's not going to work, but just go with what you think is going to work, everybody. Because I look at people that start up a business with 1 person or 2 people, and I'm like, how the hell are you going to do this? But you start off with 5, and then suddenly you're a business and 0 revenue, and so you've got less problems. So then you grow to $1 million or $2 million, and you've got to get a bit more, financially secure, and you've got less time to work on it. So you might bring on an accountant. But then it gets to a point where, one day you're looking at an Excel spreadsheet and you see a formula that the accountant's done and you fix it and you realize we're running out of cash next month instead of 12 months. And so you realize when you're now that big, you can't be dealing with mistakes like that. So then, Joel, like you said, you need to bring on talent, right? And so like a startup like ours, originally started off with all 5 of us, all in executive roles, all running it, executive roles, in inverted commas for those listening. But, today there's only 2 founders left on the executive team. It's Ben, CEO, and Harry, CTO, or James. We've got a CFO based out in Canada. He was going to move here, but COVID, so he just stayed in Canada. We've got a chief customer officer, ex-Oracle. So the financial officer has exited 3 businesses, so gone through 3 startups. We've got a guy with 25 years experience from Oracle as our CCO. We've got a guy that's been doing sales for 15 years as our head of sales. And so like the team that we're actually in, we've got Georgia, who's head of marketing now. And so kind of the team, Joel, as you you think that you're going to do a startup and you're probably going to be there at the end, or you're always going to be in the executive position. I guess my advice to people out there starting is just always do probably what you feel is right. So if you've outgrown the role or if you need better expertise, kind of that's what we've kind of done along the way. And Ben's always said that if the business ever gets to a position where he doesn't feel like he's the right person or it's too big and it doesn't feel like he can grow into that role, even though it's your own baby and you want to control it and all the rest of it, you may have to do what's right for the business and the startup. I think that's important.
Got to know when your child's grown up and ready to leave the nest.
Well, we talk about capability. We talk about capability a lot, right? And so the capability of your team now, and also the capability of what you want your team to look like in 6 to 12 months. And so what you had last year, maybe not what you need this year, which maybe not what you need next year. So it's actually gearing yourself for that. But one thing I will say on that as well is that we've had, if you look at the makeup of the team now, that without fear of sort of looking in the revision mirror, we made some senior appointments, and some of those things didn't work out the way that you'd hoped, right? And then you look in house and you have a look and you have a look at who have you got in your ranks, and you then go, we've had people that have been here for 3, 4, 5 years, and you give them a crack, and that's what we were talking about earlier with the culture piece. That these people have the opportunity to come through and they live and breathe and the business and their role in the business. And so giving them that opportunity and the empowerment and faith and belief that they can do the job, that's also been sort of really significant for us.
And you mentioned before, Ben, you're liaising with a consultancy group, PBE. Is it
PBD, Performance by Design? Yeah.
Yeah, and is that a Melbourne-based group, or is that just for the listeners out there if they're interested in looking them up?
Yeah, check it out. Can't speak highly of Neil, Ruzi, obviously Carly, Ben's wife's over there, and a ton of kind of ex-football sports people. I gotta say they've done, because they don't believe in like culture's not a one-off thing. It's saying that we've been there since day one and had some horrible kind of decisions to make along the way, and very hard, and have to kind of Harry had the saying, which is it's easy to make good decisions during good times, but hard to make good decisions during bad times. And so haven't shied away, but I think they've come in and provided tools and frameworks which have enabled people to understand how other people operate, how best means of communication. Some people exited. I mean, some part of the, I guess, the culture side is after you go through kind of a a revamp and you work out what you want your company to be and stand for, there's probably going to be some people that don't want to be on that train. And that's kind of a part of setting a good culture, is it's not for everybody. And that's okay, right? There's not ever going to be a business that is the right place for every single person. I think is key. So yeah, performance by design. Benny, if you could pick the best thing about having started Hammertech and being involved in it, what is your highlight? And if there's one thing that you dislike the most about either our startup or startups in general, like things that get people do completely wrong or get wrong, what's your best and worst?
Well, the highlight is definitely how we've been able to build something that has really resonated in the industry. And so now you just hear your name being thrown out. We've got projects in Alabama, for goodness sakes. We've got projects or the system being used in Norway and Austria and just things that you would never have expected. And we talk about this to say, just understanding statistics and the number of projects that our product is used on, we feel very confident that someone's either avoided some serious harm or maybe they're walking around today because of having used the product. The product's highlighted something that's then been rectified that you don't know what that opportunity cost is. So I think definitely the highlight is just knowing that people love using the product and it's making things safer. There's no doubt that that's the highlight for me. In terms of the low light, that's a good question.
What do you think people get most wrong about startups?
This probably gets back to what we sort of spoke about earlier. I think it's that people think it's going to be easy. They see that and this sounds like it's a doom and gloom on startups. It's not, but I think that there's elements where, when we won our first deal, we high-fived. And as you mentioned earlier, Brad, like we were getting $150 a month and we thought it was done. We thought, we've actually made it. And so I think that, so I think there's that opportunity for people to go, hey, we've got 2 or 3 clients, or we've got 20 clients, or we've got 30 clients, and you think that you've done it. And I think that that's it. People get lured into a false sense of security that it's sort of never ending, right? And so I think that it still comes back to that where people get it wrong, I think, is that they don't, and it comes back to the financial side of things from a business planning perspective, is that, we were lucky to have people like you, Brad, that understood the environment a little bit more. Like I never understood anything about capital raising. I didn't understand that you needed to raise money. Like I didn't get all of that. Coming from a construction background where it's always just been about profit, you can't run a business that in construction that doesn't make money. So the concept of technology startups that you then have to grow, and in order to grow, you sort of need to raise funds in order to be able to do that, and understanding what the interest of investors is not always just about, okay, like get to profitability. Yes, they do like profitability, but it's also about that growth story. So I think that that's probably the thing for me, is that it's just not as easy as people think that it is. And I think that when you see, and probably my biggest gripe, Brad, and sorry for those startups out there, is when you see someone in the AFR and they've all got their black t-shirts and they're like fancy writing, and they're probably missing a couple of letters in the spelling of their name.
Unless you spell a name without missing a letter, you're not a startup.
It's always good to sort of leave a couple, like an E out, and just have it finishing in an R. Again, sorry for those companies that have that. But I think that's always celebrating the raise or something like that. And that's not the glory. Like the glory is, have you got a mission? Have you got a purpose? Are you achieving that mission and purpose? Not the fact that you've just raised a stack of money, because that's not where you win.
Yeah, I think you said half the fun's the journey as well, isn't it? It's all about the journey you take, and then some of, as you said, the biggest value for you is the company and the safety it's provided, and people being able to go home at night, not getting injured on the job, and not
exactly right.
It's a huge value statement of the company, and that's unfortunately media will highlight the glorification of certain things and tell you about all the big wins and all the big capital raisings, but it's not as sexy to be able to talk about a journey and
exactly
the nitty gritty.
For me, it was like Ben on that note. It was when I was over in America, and I think I rolled out to DPR San Diego in 2017. And there was some safety data that came out 2020, I think it was, after 3 years. And, just based on their incident rates and their everything historically, and then what happened over the last 3 years, it was like just in that region, do you realize like 12 more people were not seriously injured or whatever, whatever the number was. And I'm just going, that's 12 individuals that are now living with their family or whatever that are injured, right? It gives you a bit of purpose. And not that every single business, like, that's for us was important, was having a business that could make money, but also have some purpose. And, whatever your purpose is, if your purpose is to make money, and that's it, that's fine.
That's it.
But I remember you, Ben, saying, I'm from banking, and so nothing I ever did in my career is around these days. Within a couple of years of me leaving, it's probably anything I ever did was kind of gone. And I remember you saying, you're from construction. I used to look at buildings because, you were the project manager of some of the buildings down in Docklands. And I remember going, I used to wish I was in building because you kind of look, I was a part of that building and that building's still there 10 years on, and you can say I was a part of that.
The banks care about their clients, don't they, Brad? They care about their clients.
Yes, Joel, they care about their clients.
They tell you they do on their ads and stuff.
They do, yes, Joel. And so they really do. And so you've been like, obviously built buildings. I used to be a bit jealous of that because you could, 20 years later, you could turn around and say, that's what I did. And I think, I've got to say that is the highlight as well, saying like you've changed an industry that says like, whatever your change is, it doesn't have to be like health and safety, whatever. I think having an impact and change and being able to kind of look back and say you impacted something is the key. And I think the other one is being out of the business now, day-to-day, is when I see staff that I don't even know post on LinkedIn about how much they love the company. Or you see staff that have been there, like, our first 10 employees are still probably all there. Like that sort of thing. I think a different place to work. And so when I talk to people about startups, I always say to them one of the best things is that you finally get to create a company. And it's hard, but you get to create a company that, is a good place to work when you're sick of places that aren't good places to work. And I think me and you said at the start, let's try and make money. So let's see if we can still make money, but by doing the right thing. And I think that's the other thing that I was talking to some guys in Singapore last week and about a whole bunch of stuff. And they said, sounds like you've actually been able to like be successful and not be shit, pardon pod, not be bad people. And I was like, yeah, it was one of the first things we tried to do because banks are good people and they make money.
Yeah.
Yes.
Well, we break the rules, right? We break the rules with that. And we've got a couple of people in people and culture, and we're like, well, can we do this? Can we do that? Do we need a policy for this? It was like, well, let's break down that sort of HR sort of stigma, and let's actually make it about people. And if we don't want to do something, we won't do it. And if we do want to do something, we will do it, and we'll do it whatever way we want to do it, because we've all worked in environments where you've been beholden to a process or beholden to a policy, and you're like, well, why do we do that? And you ask the question, and the expression is that that's what we've always done. And then you think, okay, well, that's not necessarily something that's progressive or innovative or necessarily something that, I want to be part of. And sometimes it takes a little while to get to that decision point. But I think once you actually get to that, then that's when you know that it's the right decision for you at that point in time.
Yeah. Last question from me, Jolly. So one more. What are you most looking forward to in the next 12 months? Or the future. Let's just say that. What are you most looking forward to in Hammertech future or your startup career future?
Well, I think that, and Brad, we've spoken about this, but there's so much heavy lifting that goes on in building a business, and when you get to that point where you start to feel like we call it the flywheel, right? It's not my invention. Everyone's used that expression before, but we've in different areas we've had a flywheel going where you've or the hamster on the wheel, whatever it is, and we're in multiple geographies now. We're in North America, and we're kicking off in the UK. And so to have a global flywheel which is on the cusp of that in North America, to sort of get that spinning, and we've had some really good traction that we've gained early in the UK. So if I could say what am I most looking forward to, it's you can see that the wheel's turning and you still see it starting to gain momentum. And I just love that in 12 months time, it's validation for the work that everybody does. Not personally, from the people that sort of work in the business. Everyone sort of works tirelessly, and so just see that flywheel spinning, and you can stand back and go, look, guys, look at what we've collectively created. That's something that for me is would be magnificent.
Leaving a legacy, which is awesome. And in tying up the interview today with you, Ben, it's been brilliant. Is there anything else we should have asked you that we didn't ask you?
No, I think it's sort of covered off a good gambit. But yeah, I just probably need to impress that for those who feel like there has been a bit of doom and gloom on the difficulties. I think that's just that reality check. But one thing I will say is that it shouldn't stop you, right, from going after it. Because Brad, if we got told, if we listen to people, I still remember people saying, "Don't do that. Like, don't go full tilt at it."
I remember people saying to us where, like, when we first went to capital, I went up to Sydney and I was trying to capital raise in 2016, and time after time, people were like, 5 founders. Are you never going to make it? 5 founders. You guys are just going to fight, and it's just going to break. 5 founders. Da, da, da. And I was like, are we doing something? Like, what?
That's
and
it.
we just went,
don't know.
And then, like, you go to the US, you're just stupid. Like, da, da, da. It's like, yeah, if you listen to everybody, like economist Joel, you're probably not going to get anywhere.
Yep, listening to too much information and noise will stagnate you and procrastinate you to no end. So sometimes you just need to go for it, follow your passion, and there's going to be rocky roads to happen. That's all part of the journey, isn't it?
It is part of the journey.
Yeah, if it doesn't eventuate, then you can obviously go back and pick up another job and earn an income, and then try again. That's it. It's resolved.
Exactly.
Great catch up today. Thanks for coming on the podcast, Ben.
Thanks, Benny.
Thanks for having me.
And Brad, thanks for organising Ben to come on and so to fill us in a bit about your journey as well with Hammertech, because as you said, we haven't really delved into your experience and history there as well. So I think it was really terrific, and we appreciate the time, Ben.
Thank you very much.
Great.
So only 50-50?
Yeah, and wrapping up today, 50-50 unless Ben has a hot 50-50.
Yeah, Ben, do you have a 50-50?
No, I was trying to think about it, but got carried away thinking about the journey. So sorry, guys.
No, that's okay. So 50-50 for the listeners out there that aren't aware is we talk about investing and startups and, angel investing and all different things. You've got different choices in life, but for investing standpoint, but you've also got different choices from a lifestyle standpoint. So we like to take a spin on that and say, okay, what's a lifestyle thing that's a 50-50 choice of yours, whether it's a pet peeve or whether it's just something that you're interested in. So today's 50-50 I had when I was just hitting some sushi rolls before is when you have sushi, do you have the little pickled ginger with it or do you not have the little pickled ginger with it? For starters, I used to hate it and I hated ginger, but I've grown to love it and I can't have it without it now.
As much as you're not supposed to, it's supposed to be like between each piece of palate cleanser, 100% I have it with it. I'm like, so Amy, my wife, whenever we get the 2 plates, they dump the ginger on the plates, they give you the wasabi. My wasabi goes on her plate, so she's double wasabi, and her ginger comes on my plate. And
you're not a wasabi guy, Brad.
I've probably got another thing to add to that, and this might be some ginger bias. I go for the ginger when it's the yellowy white kind, and I don't go for it when it's pink. So I do have a ginger bias. Yeah.
Oh, okay.
So like at Shiranui, Ben, you would get the white
soy sauce.
No,
I love it. Shiranui soy sauce, no soy sauce, and if you put the soy sauce on it, they actually get very upset with you.
Hero. I've seen the guy when he's drunk a little bit too much sake in his green tea cup, and when he sees a patron go dip that nigiri in the soy sauce when he told them, and he says he slams his knife against the table and says no soy sauce. And the guy's like, yeah. So
you're at a good sushi place when he's telling you that
with a knife in his hand.
Yeah.
So ginger, Ben, ginger if it's white.
Yeah.
Yeah. Okay. I've never met a ginger connoisseur where they're picky between types of ginger.
Well, now that you know about it, I reckon that you'll think about it next time.
I probably will. Yeah, I probably will. Yeah, great. Love it, guys.
Awesome.
Well, thanks for the catch up today, Brad.
And insights.
Brad/Arnie, where can the listeners get us at?
Money in the Tank on YouTube, Spotify, Instagram, Twitter.
Awesome. Fantastic, guys, and reach out with any questions you may have. Any questions you may have for Ben, we're more than happy to pass those on to him, and even get him back on in the future. And any questions just in general, or a great 50-50 that you've been mulling around the household there that you want to be heard on the podcast. So hit us up at Money in the Tank, any of the channels or any of the mediums. Fantastic. Look forward to seeing you guys next week.
Thanks, everyone.
See ya.